Hi, this is Claire, and today I'll be covering a topic about yields and profits. More importantly, I want to help you guys understand a little bit about today. If this year you're looking to invest, you realize that actually there are a lot of CCR properties that are launching this year on the GRS sites, and actually in the OCR region and RCR region, there are not many in the market today. So understanding yields or profits is important for you to be able to understand what kind of property investor you want to be coming in, especially if you're looking to buy something this year. So one question people might be wondering, like, can I get the kind of profits that I have seen maybe on my own, or I've seen people make over through the COVID period? And are profits really everything? We see that actually through COVID 2020, people who have entered who have earned averagely about 28% for about 4 years time frame. You see that the super good performing projects, Park Esta over here, 2 bedrooms up to almost 600k over 5 to 6 years. When upon TOP, I think the holding period was about 3 years plus to 4 years, they will have made about 428,000 for 2 bedroom. Escape 4 bedrooms have made about 1 mil on average, I guess, for over the period of 4 years, also since the whole COVID period. And one of the ones that have kind of caught the headlines this few months is 5 bedroom at 100 pumps. It's EC, actually hit about 1.7 mil profit in 7 years. So profit is really everything when it comes to property investment. This is something that we want to debunk today. So continue watching this video so we can understand a bit more. It can get a bit technical, but happy to answer some questions along the way after. So here are the questions that I want to make it like super clear that these are something we want to understand as we go along this video. One, is it going to be an anomaly? Understanding that, do we really expect that 300-500k profit is easy in the next 3 to 5 years? If not, is there any other angle that we should be looking at when it comes to property investing? Today, I kind of want to break down a bit on yields and profits so that you can understand a bit better what kind of property investor you want to be coming in today. Okay, so breaking it down a little bit in terms of definition, profits are capital gain per annum or as a whole from the years of holding on to the property. It does not take into account any positive cash flow from rental income if you are renting out the property. But for you, we're talking about rental yield in terms of rental income times 12 months divided by the price of property. We're talking about 3.8%, 4%. So if you look at city projects, 4% is a good benchmark to look at. So normally, we look at core region high yields because expect demand is high. We know that the rental you can get there is much higher. But in terms of capital gains, they are low or sometimes may be negative as well. When you talk about rest of central core region, that means your outskirts of the city, or outside central core region, you see that the yields are lower because the people in terms of rental demand is more for own stay. So rental demand is not that strong, or the rental demand is mostly catered to a bit more blue collar workers or white collar workers where the spending power is not that high as compared to people in the CCR region where they work in the city, their expects and all that. Okay, but in the RCR region and OCR region, you realize that because the demand driving the sale of the units over there, the capital gains are actually quite decent and can be quite high as well. So I'm going to answer the first question first. Is this going to be an anomaly to get this kind of profits easy in the next 3 years? Short answer is yes, if you choose the right project and if your entry price is right. But I would like to caveat that because the economy is up and down, as long as you choose the right project and the right entry price, you can make the kind of profits, but it will be maybe more conservatively in the mid and long run. But more importantly, to understand that one, it takes time, holding power is important. Two, with my second point over here, property is a form of building capital and you should look at it more as a way to build your retirement funds and keep growing the asset to be bigger and bigger so that the capital becomes bigger and bigger and it's easy for you to be able to cash out and retire in the future. Okay, and thirdly, just like stocks or every market crash, there will be opportunities and those who hold on for a longer run will definitely see profits. So I'll also be launching another video about understanding where the property market is going and understanding what are different events or cooling measures and all that will affect the property prices, so you understand a little bit about where it's going forward. But most importantly is still choosing the right project and right entry price. So this is something I got from a YouTube video, Market Crashes. So we see all the way from a century ago, right? Whenever there is a dip, the market bounces back up. So if you look at the most recent one, okay, not the most recent one, but in 2008, Lehman crisis, stock market went down 50%, but since then it also bounced back up 500%. In this case, we see during the COVID period, it went down 30%, people start buying as well, but since it's recovered as well. Now we see the problem with tariffs is also gone down 30%, but in a super short run is maybe recovered more than 5% back to normal already. So in this case, if you talk about private property sales in Singapore, if you look at over the decades, actually you see that the prices have definitely, there are dips, yes, here, but overall the prices are still in the gradual increase, and it's largely contributed to where the economy is going, how they control the prices as well, understanding that price should be moderately going up and not super steep curves as well, so that we know that for Singaporeans it's easier to afford. So all these factors come into play, understanding where the property market goes, but more importantly, I feel that it's more of choosing the right product and the right entry price for you to be able to maximize your profits. So the second question that you want to answer is it's not so easy to earn this kind of profits in the next 3 years. Let's say we're talking about a rocky climate in the next 3 years. Is there another angle we should be looking at when it comes to investing in private property today? And that's where we really break down in the use and profits to see what might make sense for you today, especially if you're coming to enter the market this year. So what should we be focusing on in today's market? Whether is it profits or you, and I'll break down both. But before that, I want to recap a bit. Central core region, you get high use, but capital gains might be low. OCR region, you relatively get a bit lower use, but your capital gains are decent depending on what product you choose and what bedroom type. So here what I want to do is I want to lay out two case scenarios. If you enter into a OCR property versus you enter into a CCR property, what can you potentially get in terms of returns at the end of 5 years, for example? Okay, so here, assume you're a couple investing in property together, you're both employed, with CPF contributions, you buy a 3-bedroom here at 2.5 million property, you rent it out for $5,005 a month. Your mortgage in today's interest rate is 7,000 plus per month. You minus your CPF is about 4,000 plus a month. Minus property tax and maintenance, actually you net like zero positive cash flow. That means you kind of break even in terms of the cost. But because you're in the OCR region, as long as you choose the right project and the right bedroom type, the right unit, you conservatively, I would estimate that you make about 300k conservatively in the next 5 years. Okay, so there's one case scenario coming to OCR region. Coming to CCR region, right, what is the angle that I want to drive at and help you understand a little bit more about buying the CCR and what the strategy going forward if you want to come into CCR region. So assume you're the same couple investing in property together. You buy a 3-bedroom, 2.5 million property in the CCR region, regardless of how small. You rent it out $8,000 a month, and this is purely just for investment. Your mortgage is the same because the value of the property is the same. Minus the CPF and minus property tax and maintenance, you are net $2,003 positive cash flow every month. So you take back $2,300 positive cash flow in a month, but at the same time, because you're using your CPF and all that, this amount of cash that you get, you invest into some high yielding funds, and conservatively over 6% you can make about 160k using the positive cash flow that you have. If you do find something that has better return, 8 to 10%, you can almost make about 200k in 5 years. If you take the 2003 or plus any additional cash that you have and put it into better yielding funds, or if you know how to invest carefully and properly and you know where to find these returns that are much higher, then definitely you can be able to almost match what you get in the OCR region. So which one makes you better off? If you buy a profit product, which is your RCR region, you're looking at 300k almost guaranteed, just a matter of time. It may not be 5 years, it may be 6 years, it may be 7 years to get a 300k. At the same time, for the U product in the CCR region, conservatively you can get about 200k kind of returns using the positive cash flow to go and put in high yielding funds. It could be more if your funds are put in better positions. There is a chance of capital appreciation only if your entry price is right. So if let's say today you put in better positions, you earn a bit more, and two, because your entry price was right, you manage to make another 100k. In this case, right, a U product might make more sense in terms of understanding the money coming back in your pocket, just comparing these two products at the same time. So the conclusion here, short one, is can you see these profits in next 5 years for RCR, OCR region, or even in the CCR region that I just mentioned? Yes, I think you still can, but it's really about choosing the right one at the right entry price for you to be able to maximize that as a property investor today. And two, can you buy in the CCR region this year? My conclusion is that yes, there is an opportunity. Also because in my previous video, I also shared that the price gap between the CCR region and RCR region has narrowed to almost similar right now. So yes, there is an opportunity, but it has to be carefully selected. So to give you a quick overview now is to understand like where the CCR prices today are and where are the RCR prices today. So for One Marina Gardens, Opus, which is 999 project, Collective at Sophia, and Orel, out of these four, because this is 999 years, the quantum is slightly higher, but out of these three projects are all in the city area, they are going around 2.8 range. But if you look at the RCR area, and the reason why I say that it's narrowed to almost similar is because Emma of Katong RCR has already transacted 2.8, Tembusu Grand 2.9, Ori even 3 mil, and Trump Park, which is OCR region, actually has even already hit 2.764 mil. So in this case, actually you are really buying CCR price for RCR pricing. So I hope that gives you a bit of an overview about if you're buying something just purely for investment, not really so much for own stay. If you're talking about use and profit, yes, actually a lot of people, since they have already tasted like the goodness of profits over the past 3 years through COVID, they want to be able to see it again in the next 3 to 5 years. Conservatively, I would think maybe 5 to 7 years is a better time frame to look at. But at the same time, I feel like CCR is a good opportunity today. When you talk about just purely investment, you want to rent it out, as long as your entry price is right, there are other more factors to consider in terms of why people might come into CCR, and I think that it will be a pattern of locals coming to CCR more, and that's also because we kind of break the perception that CCR is always more expensive. Now that you see that the prices have already narrowed down to the same for RCR and CCR region, there might be an opportunity where locals want to come and settle down into the city area more, and that will bring more demand and the prices going up as well. But of course, you need to be able to choose the right one. So in my previous video, in terms of looking at investing in CCR this year, there are some recommendations that I have posted over there, so you can feel free to look out for that video. I'll put the link down in the description box below. If not, this is my WhatsApp number, this is my Instagram as well, you can check it out. If not, you can pause this video to scan the QR code to WhatsApp me directly if you have any other questions, and then I'll see you in the next video. Bye!